Every new point added to the S&P 500 and Nasdaq and Kospi, they all feel like another Jenga block balancing on borrowed stability. The rally keeps climbing, dip buyers keep showing up, and AI optimism certainly keeps convincing investors around the world that this market can absorb absolutely anything. But underneath the surface, the pressure is building fast. Yesterday's US inflation data, for example, came in hotter than expected by analysts, with both headline and core CPI figures moving away from the Fed's 2% inflation target, just as oil prices are pushing back above the $100 per barrel level. And while global oil inventories are falling at a record speed, bond yields are climbing again on inflation expectations, and the Middle East war remains stuck in a dangerous impasse around the Strait of Hormuz. So the big question is, can this keep going? So welcome to Swissquote's Daily Market Talk. It's Wednesday, 13th of May. I'm İpek Özkardeşkaya, and everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
No surprise, ladies and gentlemen, the US inflation accelerated in April. But the data released yesterday in the US pointed that it accelerated more than expected by analysts for both headline and core inflation figures. The former rose to 3.8%, heavily impacted by the rapid rise in energy prices. The latter, the core inflation, the version that excludes food and energy prices due to their volatile nature, rose to 2.8% year over year. Both significantly higher and decidedly moving away from the Fed's 2% inflation target. That was the predictable outcome of the Iranian war, which pushed the US gasoline prices around 65% higher since the beginning of the month of March. On the front line, the Middle East war is at a standstill today. Latest news suggests that the Iranian crude exports from the main export port Kharg Island have also stopped. On the diplomatic front, US and Iran are not capable of finding an agreement to open the Strait of Hormuz. Oil flows are disrupted and global oil reserves are nosediving, pushing oil prices higher. Crude oil indeed was up by more than 3% again yesterday. It is consolidating above the $100 per barrel level this morning, a little bit softer but with the risk of another upside move. Cherry on top, the Russian oil flows also slowed last week as several drone warnings reportedly disrupted ship loadings there. So oil prices remain high. Higher oil prices press inflation higher, but not only, it also tames economic activity by rising operating costs for businesses. For households, it squeezes affordability. In the US, for example, the headline inflation now equals the wages growth. Leading names including McDonald's and Kraft Heinz warned just last week during their earnings call that consumers in the US are now running out of money, meaning that if Americans who love spending will keep spending, they will have to do it by taking on more debt. And while consumer loans in the US are at highest levels on record, they are mounting decidedly, while interest rate cuts are no longer on the menu du jour in the US. Well, that's not an excellent build-up for healthy growth, is it? The thing is, elsewhere the picture is not sunny either. In Germany, for example, the diverging expectations for inflation and growth is as striking. It is screaming stagflation, which is high inflation, low growth, something that central banks absolutely hate. And the energy crisis view too. Surging inflation, trade war, Chinese EV competition, too much regulation, too much bureaucracy in Germany, while the country has not been able to keep its head above water since the Ukrainian war started a few years ago. And while the rest of Europe is as slow and as desperate to see their energy prices eat into their own purchasing power. To make matters worse, the European Central Bank is expected to hike the interest rates maybe 2 times, maybe more in the second half of this year to fight inflation. Let's continue the horror tour. Across the channel, Brits are grappling with their own political shakeups after Nigel Farage scored big in the latest elections. The name Farage in the markets resonates as a clearer path toward looser fiscal policy in the UK, higher spending and larger deficits, just as investors are already very much worried about Britain's debts and inflation outlook. And that terrible combination is pushing investors to demand higher compensation to hold UK's government debt, sending the UK 10-year gilt yield back above the 5% level. That's the highest since 1998, mind you. And the higher the borrowing cost, the less the government could borrow, and the impact on growth would be negative. That's exactly why the higher yield is waiting on sterling appetite instead of boosting it. Cable indeed has tested the 1.35 level to the downside yesterday. Bears were also encouraged by a stronger US dollar post US CPI data. And well, even in the quiet and peaceful Switzerland, price pressures are loudly felt at the pump, meaning that even a strong Swiss franc has not been enough to fight back the energy-led inflation. To say. As such, global bond traders are worried that the central banks will have to raise the interest rates to tame inflation. Economists are worried that the rate hikes will not do much other than further slowing down the economies without necessarily deflating prices, as the problem here doesn't come from the demand side, but from an external factor that will not go away with higher rates overnight. And I'm telling you, for the US, cutting the interest rates into a rising inflation is not an option anymore, even with the Federal Reserve's brand new central banker who would, we all know, lower the interest rates as soon as he could. But the war in the Middle East should end first. Meanwhile, we all understood that the AI spending keeps the US economic growth afloat, at least better than the European peers. The US jobs market slows, but the payroll numbers there defy the mass job terminations announced by big technology companies and threat of slowing consumer spending. As such, the US 2-year yield that best captures the Federal Reserve rate expectations rose to the 4% level yesterday, just after the inflation data came in hotter than expected. Here, the US dollar rose too on the back of higher oil prices and a hawkish shift in Fed expectations amid the inflation report. As a result, the dollar-yen advanced above the 100-day moving average, headed into the 158 level. Soon going to be time for shorting the dollar-yen and waiting for the Japanese authorities to intervene. On the equities front, the S&P 500, which has fully ignored the rising yield since a month, finally blinked and fell yesterday after the CPI data, but recovered losses as dip buyers joined in near the 73.40 level. Amazingly, futures have also flipped into the positive territory this morning from earlier losses. News that Nvidia's CEO Jensen Huang will also join Donald Trump in his trip to China apparently helped. And in all cases, the market is so crowded with dip buyers today that the dips barely become perceptible. Every new point on the S&P 500 Nasdaq actually feels like another Jenga block balancing on borrowed stability. Now I'm saying that because the Korean Kospi erased $300 billion worth of value in less than 100 minutes yesterday after a high-ranking politician there threw in the idea that the big winners of the AI race, yes, we are looking at you, Samsung and SK Hynix, should pay citizens a dividend via taxes on AI profits. And earlier this month, Samsung's labor union also claimed 15% of operating profit to be handed to chip division employees. 15%. Or employees would go to an 18-day strike. Apparently, the company and the union couldn't reach an agreement just yet, increasing the chance of a strike, according to the latest news, while the memory chip shortage due to the massive AI demand remains a major headline in the tech industry. The timing would be indeed very bad. Nevertheless, Samsung rebounded this morning thanks to a strong appetite on expectation that the company will be earning $220 billion in operating profit this year. Yes, that's more than Apple, and yes, that's also more than Alphabet. It is just less than Nvidia, which is the world's most valuable company, so it's a huge amount. And obviously the latter has been whetting investors' appetites for months now, leading to a 455% rally in Samsung's stock price since a year, a more than 1,000% rally in SK Hynix stock price, and a 250% rise in Kospi over the same period. All are deep in the overbought territory. All are calling for a healthy correction to release the building pressure to keep going. So when will investors say, enough, we're taking our profit? Time will tell, I guess. So this is all for today. I'm İpek Özkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.